people assess their monthly expenses at the end of the month in order to consider their financial situation. This statement of their expenses helps them make future spending decisions within their budget by letting them know how much cash they have available for a given time period. Similarly, organizations also make financial statements of their spending and earnings within a specific period. This statement reflects all types of transactions, including the ones which are made with cash or without cash. Additionally, this cash flow statement is a statement of transactions that includes both earning and spending. It assists a company in making critical financial decisions within a predetermined budget for the future. Let's take a detailed look at the cash flow statement and understand its significance. What is a cash flow statement? A cash flow statement, also known as the statement of cash flows, provides a detailed breakdown of the cash inflows and outflows over a specific period. It helps stakeholders understand how a company manages its cash position, where the cash is coming from, and how it's being spent. Calculation of cash flow statement. Cash flow is calculated by making some adjustments to the net income by adding and subtracting the revenues, credit transactions, listed on the balance sheet and income statement, and other expenses that result from the transactions that happened during a particular period. These adjustments need to be made because non-cash items are calculated into the income statements and total assets and liabilities in the balance sheet. This is why many items are re-evaluated while making cash flow statements because of the non-cash transactions. There are two methods to evaluate the cash flow method. 1. Direct method. This method evaluates the actual cash flow information of the organization's operations, that represents various types of cash payments and cash receipts from the customers, paid out cash in salaries, and receipts of cash paid out to suppliers. These figures are evaluated by using the beginning and ending balance of the various business accounts and evaluation of net increase and decrease in the accounts. This method is commonly used by small firms which do their accounting on cash rather than on an accrual basis. 2. Indirect method. This method derives information by taking the net income from the income statement and changes on the balance sheet to arrive at the amount of the cash generated by the operating activities during a particular time period. Both the income and balance sheet are prepared on an accrual basis. Operating activities are one of the key components of a cash flow statement. Let's understand the basic components of a cash flow statement. Components of the cash flow statement. The cash flow statement has 4 components. Let's take a detailed look into them. Operating activities. This shows the main source of the organization's income generation, which is considered to be the most important information on the cash flow statement. This section of the cash flow statement represents how much cash is generated from the organization's core products and services. A positive cash flow is a sign that the organization's financial health is good. These operating activities include 1. Receipt from sales of goods and services. 2. Interest payments. 3. Rent payments. 4. Income tax payments. 5. Payment made to suppliers and services used in production. 6. Salary and wage payment to workers. 7. Any other type of operating expense. In the case of an investment company or trading portfolio, debt instruments, equity instruments, and receipts from the sale of loans are also included in the operating activities. Investing activities. Investment activities reflect the changes in equipment, assets, or investments relate to uses of cash from the company's investment. These activities include investing in 1. Equipment. 2. Building. 3. Land. 4. Furniture and fixtures. 5. Vehicles. 6. Long-term investments. Cash changing from investing is commonly considered as cash outflow because the cash is used to buy equipment, assets, and short-term assets. When a company relieves an asset, the transaction is considered to be a cash inflow. Financing activities. Any changes in loans, stock options, debt, long-term borrowing are reflected in the financing activities. These financing activities can include 1. Short-term, long-term notes. 2. Bonds payable. 3. Deferred income tax. 4. Preferred stock. 5. Paid in capital excess of par preferred stock. 6. Common stock. 7. Paid-in capital excess of par common stock. 8. Paid-in capital from treasury stock. 9. Retained earnings. 10. Treasury stock. When a company raises its capital, it is considered as a cash-in. On the other hand, when a company pays out the dividends or the debt is reduced, it is considered as a cash-out. Financial activities reflect how borrowing affects the company's cash flow. Supplemental information. Supplemental information often includes the primary three components of the cash flow statement. Supplemental information reflects the exchange of the company's stocks for its bond, which did not involve cash. Supplemental information also includes the amount of income taxes and the interest rate paid. Uses of cash flow statement. Cash flow statement shows exactly how much operating cash flow an organization has, in case the organization wishes to use it on new projects. This information helps the organization to spend the money within the budget. Cash flow statement shows the changes in liability, assets, or equity in the form of cash inflows, cash outflows, and cash being held. These categories are the core of business accounting. Cash flow statement allows the organization to predict the cash flows in the future. This future cash flow prediction gives an idea of how much liquid balance the organization will have in the future. This prediction can further help to fulfill long-term business goals. And there you have it, a comprehensive look at the cash flow statement. Understanding this financial statement is crucial for making informed business decisions and investments. If you found this video helpful, please give it a thumbs up, share it with your friends, and leave any questions you have in the comments below. And remember to subscribe to Goodwill Wealth Management for more financial insights. Thanks for watching, and we'll see you in the next video.